Good morning. It's Wednesday, December 10th. I'm Phil Streible, Chief Market Strategist at Blue Line Futures. So it's going to be a real busy day today with the FOMC meeting here. Now, yesterday I did cover natural gas on CNBC, and I talked about the market and its volatility here because of the fact that we saw natural gas break out from 450 on up to 550 before crashing back down to that old resistance point, which is now the new support level. So if you look at natural gas technically between August, September, October, it traded between 4 and 450, and you had the breakout on November 5th. So you look at natural gas, we do have near record natural gas production, 109 billion cubic feet per day in December. What happens is that when you do have this surge in prices ahead of these polar vortexes, the market will have to reprice itself in response to the rate of change in supply and demand estimates. So what happened was we had this polar vortex that was supposed to come through, supposed to eat up all the available supply, the injections, and then create a massive drawdown. And that weather model had shifted north. So what happens is you have this now excess supply. So natural gas prices crash back down. So what I believe, though, on natural gas, real quick, is that long-term demand for natural gas is going to continue to grow. Natural gas's role in AI is expanding because of the fact that natural gas creates electricity for the grid by using its chemical energy to spin a turbine that's connected to a generator. So many of the tech in data centers and developers are building their own dedicated on-site natural gas power plants that has supplied almost half of the electricity for AI data centers. So natural gas is going to play an important role in the expansion of AI, electricity, the grid, and things like that, and ties into much of our precious metals, our industrial metals thesis that many of these markets, like the copper market, is going to continue to rise and the floor is going to be lifted going forward. Now, if you look at the silver market reaching a new all-time high overnight on the March contract, 62.14, silver's really extending its gains here with the momentum coming from supply tightness overseas and further bets on monetary easing by the U.S. Federal Reserve. So the market is also dealing with the aftershocks of a historic short squeeze. The one-month leasing rates, which represent an annual cost of borrowing the metal in London, remain elevated around 6%. I'll run that new data here after the close here when things die down. And this comes even as a record amount of the metal had flowed into that trading hub over in London, and those flows have put other centers under pressure. So Shanghai inventories are at near the lowest level in a decade. The thing about silver, I had a lot of people reach out to me and they were like, it shot up $2.40. Like, oh my God, this is alarming. The reality is that these types of moves, when you look at it on a percentage basis, are not really as relevant, in my opinion. It's just more natural here, and you've just got to adjust your position size based on volatility. Because if the market goes from, say, $25 to $30, well, that's a 20% move. That's huge. That's crash type moving. The market had crashed higher. 20% represents generally a crash. But you go from 30 to 35, it's like 16%, 40 to 45 is like 12 and a half. 50 to 60 is like 9, 70 to 75 is like 7%. So these aren't as big of a moves, in my opinion, because of the fact that you get this market repricing itself higher. So that's the similar situation with the gold market. So going from 4,000 to 5,000 is not really that big of a deal. And that's where our long-term analysis predicts that the gold market should be able to achieve in 2026. No guarantees there, but it's just my opinion. Now you look at the gold market here. It is pulling back a bit, 42.25 overnight, running into some resistance near that 42.50 level, getting down to about 42.15. We've seen it trade in about a $50 range and is consolidating. And it's really holding its breath to see what the Feds are going to do. So you look at the stock market, slightly lower here ahead of this tricky Fed meeting here. How are things going to play out? And then you do have Oracle results later. So some betting markets are looking at the number of dissenters out there with as many as 3 dissents here in the S&P 500, down about a tenth of a basis point here at 68.45. The NASDAQ down about the same amount, 25,668. And then you look at some equity insights. So Oracle's announcement will be closely watched for clues on the AI trade here with the option market. The implied move is about 10%. And that is going to be about what we've seen over the last 2 years. Now, last print we saw on Oracle had about a 36% rally. So if you look at the interest rates and you look at that Fed meeting we have here, markets are now anticipating an 89.9% likelihood that the Fed will reduce rates by about 25 basis points at this meeting here today. So that time that it's going to be released is about 1 p.m. Central Time. The key, though, so you're going to want to look at 1 o'clock Central Time, did they cut rates or not? And then secondly, you'll have this break until 1:30 when Fed Chairman Jerome Powell comes out, and then that's where really he could pull the rug on this market here if he's very, very hawkish here. And the dot plot only prices in, say, one interest rate cut in 2026. That's where things can be quite problematic. Now, you go overseas and you start looking around the globe. Well, traders are pricing in virtually no interest rate cuts out of the ECB. Remember, what they're having is they're going through a stagflation period right now. And then you go to Japan here, they're expected to also increase interest rates, and Australia is expected to increase interest rates 2 times next year. So these other markets here are in the interest rate hiking campaign where we're in the cutting here still. So you get the dollar index here at 99.17, you get the euro currency 116.34, you get the 10-year treasury yields, and this is a bit alarming, sitting at about 4.2%, so big breakout to the upside. You get over 4.25, you're probably going to see some turbulence here in the equity markets. You got the VIX futures at 1768, so nothing really there. Bitcoin at 92,500. The S&P Gamma exposure is still positive Gamma. You go over to Europe, you go to Asia. Well, European stocks, they slipped here with that widely anticipated Fed interest rate cut. Concerns about global monetary easing cycles that are all coming to an end because of the fact we just outlined that, Australia, Japan, ECB are all looking at rates unchanged or higher. Then you get Asian equities. They're trading in a narrow range here with the MSCI Asia Pacific Index edging up about 0.2%. You go to the ETF flows, no real action here overnight. So they sold some gold, sold some silver, bought some platinum and palladium. So they cut about 14,000 ounces on the gold market. They cut about 1.1 million ounces on the silver market. And again, back when silver was breaking out, we got a 1 million ounce move here in the ETFs. I was like, holy smokes, now it's just like a normal day over here. So palladium holdings, they did increase about 1,000 ounces here, but it's the 5th straight day of increases. No real action though. Palladium sitting at about 1530. Something to note is that the gold silver ratio, it's not actionable, but it's an observation. It's 68-1. So a lot of interesting things out there. Today's going to be one of those days where you sit back, don't take on a lot of risk, eat your popcorn, watch what's going to happen here, maybe trim a couple things off, maybe put some protection on ahead of that Fed meeting. And then I'd look to hope that we see, and hope's not a strategy, that we get some kind of material breakdown in the equity markets for a long-term dip buying opportunity. But that, again, that's just my opinion here. So you guys got any questions, give us a call, shoot an email, info@bluelinefutures.com. Remember that futures and option trading does involve risk of loss. May not be suitable to all investors. Good luck, good trading.